Joining us this morning, Interactive Brokers Chief Strategist Steve Sosnick. Steve, it's great to have you. It's kind of interesting to watch Tesla lower in a pretty good tape today. I wonder how much of this year-to-date momentum you think is sustainable.
Good morning, Carl. The momentum is fickle, right? It can kind of come and go. And I think today, Tesla, as Kate noted, remains the most active stock here on a daily basis for I don't know how many months straight. But it looks like today more of the momentum is moving to Microsoft and moving to the AI plays. Investors do vote with their feet from time to time, and Tesla has had a remarkable run since its lows at the start of the year. It's understandable if after pretty much of a doubling, they're moving on to something else and possibly reallocating some of their momentum chasing strategies.
No, an official doubling as of last week. The options volume that we mentioned in the lead, do you think that's introducing risk into the market, or is this sort of just a different story that history's repeated over and over?
It's on the macro level, I'm going to say no, because there's nothing really fundamentally changed. What changed is we now have daily expirations in most of your key ETFs and indexes, SPX, NDX, QQQ, SPY, et cetera. And so we've seen last week when option volumes were hitting a record, actually a week and a half ago, sorry, when they were hitting a record, we saw volumes roughly 2.5 times what we saw prior to the introduction of zero-dated options. The volumes more than 2.5 times in spiders and Qs. So you're going to get what I call micro bursts of volatility. We're going to see volatility moves as people chase momentum trades in SPY and QQQ. We saw what we called the gamma squeezes during 2021. We can start to see those in Q and SPYs, not necessarily every week, but actually every day in theory. But in terms of the broader market, we'll come to deal with this. It's not a brand new financial innovation. It's just a change in the way we've been doing business. Markets adapt to that sort of thing.
Steve, we got to talk about the AI effect, not just on smaller stocks, but on some of the very biggest, mainly Alphabet. I mean, what is going on here? Microsoft is up about 6.5% over the past week. Google, parent Alphabet, down 8.5%. Is this just really a sentiment shift? And how should investors think about the way this is likely to continue playing out, perhaps even after this risk-on trade, at least for the first few weeks of the year, has petered out?
John, this is where the fundamentals meet the momentum. We can certainly argue that the ChatGPT purchase has been a huge boon to Microsoft. If nothing else, it's more or less paid for itself, depending on the time frame. 15 times over in terms of market cap. But do these trades get overdone? How many people the relative performance, let's say, of Chat AI in Bing versus ChatGPT rather in Bing versus the failed attempt that Google had. Is this going to really change people moving from Google to Bing? That's a big hurdle to overcome. And so another thing to keep in mind here is at Microsoft, you're paying a PEG, the price earnings over growth ratio of about 2, whereas in Alphabet, Google, you're paying more or less 1 times growth. So there's definitely an expensiveness to Microsoft that you have to wonder. It's fun to chase the momentum over pretty much any Chat GPT related time frame. Microsoft has outperformed Alphabet by about 12 to 15%. I'm doing some work on that literally, which I'll have out today on our website. But it's been a trade.
That's for sure. Something we've talked a lot about, and we'll see if this event that they supposedly have planned in March is anything. We might talk about it next month too. Steve, that was great. Thank you. Steve Sosnick.
After the break, the glue that keeps network TV together. We're going to take a look at just how much NFL viewership matters across broadcast and cable. And then Zillow moving higher on an upgrade this morning. Evercore says it could surge 40% in the next 12 months. The analyst behind that call is with us. Don't go away.
This weekend Super Bowl reminding us more than ever how important sports are to network television. SVP Moffat Nathanson out with a note saying, quote, with the NFL making up 82 of the top 100 telecasts in 2022, it's clear that sports, in particular the NFL, remain the glue to the linear bundle. He notes that while average viewership for the season dropped by 4%, if you exclude Thursday night, where viewers flocked to Amazon, ratings were in fact up 1%. That's on top of a 9% jump from last year's season. But as the media landscape continues to shift with the rise of streaming, what is in store for the future of live sports, Dee? This is what we're all asking, and to what degree does big tech act as a marginal buyer, inflating values even more?
Exactly. I mean, people are sticking with linear TV because that's how the majority are still going to watch it. But, John, we know that things are changing very, very quickly. YouTube TV spending billions on the Sunday night ticket. It's likely only going to increase. The question is, what are they going to pay up for, right? If amid the backdrop of layoffs and some macro uncertainty, do those rates come down a little bit, or does big tech keep splashing out for it? It kind of feels inevitable.
Yeah, I think they keep splashing out for it, but also for investors, this is a little bit of a cautionary stat. And to me, it speaks to, with live sports that are popular, this is something that AI and something that the metaverse cannot replicate, right? They're not creating these must-watch, mass-market moments. Because, I mean, if a computer made it, yeah, it can make it at any time. So there are limits to what this technology can do. And sports is actually using some of this, though. The augmented reality, there's so much of it in the Super Bowl. So, you know, it's augmented a lot of these times with the humans, not necessarily against them.
Fair enough. I like the commercials, by the way. I had Canadian friends who, over this weekend, who enjoyed seeing all the American commercials. And I don't know if you guys saw the Tubi one. Everyone in the room we were with freaked out, accusing everyone of sitting on the remote.
Do you think of them as American commercials?
I do, very much so. Years and years of subpar commercials. I'm thrilled about it.
I mean, Canada owes everything to Crown Royal at this point. That was amazing.
That was a good shout out. I agree. After the break, guys, Evercore's Mark Mahaney is with us after raising the roof and upgrading Zillow to outperform. We're back in 2. Let's take a look at Zillow. Shares are up some 42% year to date. Our next guest likes what he sees, upgrading the stock to outperform this morning and nearly doubling his price target to $61. Evercore ISI head of internet research, Mark Mahaney, joins us now. Mark, this is essentially a macro call, right? What makes you confident that the housing market is recovering or will recover this year? And that, I mean, a 42% rise, this isn't already baked in.
Yeah, thanks, Deirdre. So this is a part of macro call. It's heavily that way. Our home building analyst, Stephen Kim, thinks that our house view, pardon the pun, is that EHS, or existing home sales, and home prices are likely to trough out, bottom in this March quarter and then recover. So I guess we lead with that. What we know historically is that there's a very high correlation between Zillow's key premier agent revenue, the vast majority of its revenue and its profits, with existing home sales. So this should fully participate. Then we look at the traffic data. Zillow has kind of become synonymous with residential real estate in this country for 10 years. So popular that Saturday Night Live did a skit about Zillow, a year or two ago that was highly popular. And so, yeah, we haven't seen any change there. It's about 50% of all traffic. And then we think this is a high margin business. Prior to the kind of major correction we saw in the market last year, I mean, Zillow was rocking along at 40-45%, margins, EBITDA margins. I think they may have been over earning, but still, there's a nice path to recovery, and this company will kick off material amount of free cash flow. So that's why we upgraded the stock. It's an early cyclical call. That may be our mistake here, but if there's a cyclical recovery, Zillow's a great way to play it, we think.
Mark, where are you on the iBuying model? You noted in your note that Zillow was faced with a lot of volatility in share price because it didn't do that particularly well. But if the market is going to recover, could that have an iBuying business made Zillow's business even bigger, the company bigger, versus an Open Door, which is still down huge over the last 12 months, but has been on an incredible rally this year?
Let's see. iBuying is an extremely difficult, challenging business. It's the benefits of that accrue to the scale leader, maybe. And Zillow wasn't the scale leader, so they probably made a mistake of going in. They certainly made the right move to get out of that market, and they avoided a lot of the massive losses. There are other parts, though, of Zillow that I like. Some of the other product development areas. They've been getting deeper and deeper into mortgages. They're trying to create more value for both consumers that come to the site. This is the leading website for users who are consumers that are looking to buy or sell homes. So there's an enormous amount of information in there, and there's information that allows people to also get mortgages via Zillow. So you kind of get greater value for consumers. And on the real estate agent side, you're trying to create a marketplace here. They've got this wonderful tool called Showing Time, which is a good touring tool for agents. So I like that product development. That's why I think there's a little bit more than just a cyclical call here. And I think this product development can help them regain or gain more share of the overall market.
Mark, if I'm not mistaken, we're getting earnings from Zillow in just a couple days, and lots of attention to costs these days. So lots of top-line potential that you see from them on the housing market. But how are they doing on costs? Do they need to cut? Have they been efficient up to this point?
No, they haven't been efficient, but they did. That's why they had to do two RIFs. They've done reduction in forces layoffs. So they've had to do two pretty sizable ones. Now they're probably much more efficiently set up. And it is intuitively or instinctively, it's a high margin business. Again, something like this with 70-80% gross margins, 30% plus EBITDA margins. Yeah. So yes, they overhired, and they particularly did when they made this iBuying bet. And as they peeled back from the bet, they also they had to take a lot of cost cuts. You want to be long names that have already taken out, have already taken cost action. Zillow's one of them.
Mark Mahaney, thanks very much. Talk to you soon.
Thanks, Deirdre.
There can always be more cost actions, though. Speaking of, up next, 11,000 Meta employees have already received notice of being let go. Are more job cuts ahead? Plus, some management changes coming. We'll be right back.
One more thing this morning, Meta announcing a few moments ago that its chief business officer, Marnie Levine, will be departing the company. Levine had been at Meta for 13 years and led the company's advertising business. That's on the heels of this report that the company's delaying setting team budgets as it braces for another wave of layoffs. Let's bring in Julia Borston to dissect both of those news items. I guess Levine first, JB.
Yeah, I mean, it's so interesting here. Levine had been at the company for 13 years. She is planning to stay on through the summer to manage the transition. And as part of this departure, the company is elevating two people who've also been at Meta, Facebook for a long time, into expanded roles. Nicola Mendelson and Justin Osofsky, both managing sales and partnerships in expanded roles. They say that this new structure will help bring the business and product teams together and operate more efficiently. But there's no doubt that Marnie Levine's departure is a big loss. She had, known various parts of the company very intimately, having worked in public policy. She was COO of Instagram. So she's really held various key roles at the company. And I would just point out she was very close to Sheryl Sandberg, brought in by Sandberg. And to me, she sort of represents some of the departures that we've seen at the company, including of Carolyn Everson. I would point out these are three very senior women who left the company in the wake of the transition from Facebook to Meta. So just want to keep an eye on that there.
Julia, you're alluding to something that I wanted to ask you about. Is it clear, now that Sheryl Sandberg is gone, who is the center of business gravity at Facebook now, and to what extent they have buy-in across that crucial portion of the workforce?
Well, I would say what they're doing now is kind of spreading out that center of the business relationships. Marnie Levine was clearly in one of those key roles, right? She managed a lot of those key business relationships. She, in many ways, was sort of elevated to be another Sheryl Sandberg, although she was not the COO. That was a different role. But I think what's key here is they're splitting up Marnie's role really into two different roles that will both report up to the COO.
I would add one name to that list, Fiji Simo. She went to be the Instacart CEO, Julie. And I wonder, what does this tell us about succession plans? Do we care about succession plans at Facebook? It just feels like they've lost a lot of high-profile people over the last few years that could potentially step into that role.
Yes, look, they have lost a number of high-profile people, and you're right, those are four very senior women who have left. But what's interesting here is when you look at succession, Meta, Facebook, it's a very different type of company. Not only is Mark Zuckerberg very young compared to some of the companies that have been reckoning with succession issues, but you also have the fact that he does control the company. He has voting control over the company, Carl.
Pretty interesting moves there. Meta, of course, one of the big S&P gainers so far today. Julia, thanks so much. So Dow close to session highs. Really not too much worry circulating CPI tomorrow. By the way, tomorrow earnings will begin to pick up pace a bit. We'll get Coke and Marriott and Zoetis. Yields have remained down. We got up to 3 3/4 on the 10-year, but currently 3.72. Let's get to the judge and the half.
All right, Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the state of stocks after the worst week in a couple of months. And with tomorrow's CPI now looming large, we get you set up for that with some fresh moves from the investment committee. Joining me for the hour today, Jenny Harrington, Steve Weiss, Joe Terranova. Everybody's at the table. Happy to see everybody here. Let's go to the wall, see what we're doing. 12 noon in the East. We've got green across the board, as you see. Dow's good for 285, we'll call it. S&P near 1%. NASDAQ outperforming today. Yields at 372. That is on the 10-year. But, Joe, we're waiting for the CPI. J.P. Morgan games it out, as they always do, and we like to bring our viewers that information, sort of what they're talking about, what the likely outcomes are, and what the result will be in the stock market. 65% chance, they say, it goes between 6 and 6.3%. Okay? Remember, it was 6.5 last time.
Okay.
That's bullish, they suggest. Get a 1.5 to 2% pop, but you see the rally faded. My point is, like, you got a bunch of potential outcomes, and we're hanging on this next big hurdle for this rally.
It's interesting because I actually see the pressure being on bears, not so much the bulls. I think bulls are in control here. I've said this all along. I think you've got a little bit of a runway through the spring where the market can rally, and then the lag effect of what monetary policy takes effect. But inflation and the report that we're going to get tomorrow, we know there's going to be several distortions. The weightings have changed for how it's going to be calculated. So owner's equivalent rent now has a higher weighting. That's up to 25%. The shelter component is going to be a little bit hotter than expected. In addition, used car prices, which in January were up 2.5%. That's the first increase that we've seen since June. The used car pricing is actually going to have a lower weighting. So there's going to be some distortions in the report. Understand that. I think the good side of the economy is going to look better. I think the services side of the economy is going to look more difficult. And I think the road for inflation is going to be bumpy. But unless you see a very hot number, when I say a hot number, I mean month on month up 0.6, core up 5 to up 0.6. Last month we were up 6.5 year on year overall. I think you need to see up 6.5 year on year overall, because if you fall in that 6.2, 6.3 area, market's going up.
So Weiss, the bulls are in control. Okay, that's what Joe just said. You agree with that?
For now, you do. Come on, you do.
Actually, I don't agree with the characterization. I don't know that anybody's in control right now.
Only you could come up with that. Only you would put yourself into a pretzel twist to come up with that answer.
No, the
stocks have been rallying, right? It's been hard to push the market down, right? Yep. The bulls feel like they have some newfound momentum. Wouldn't you agree with that?
No, I definitely see this momentum. I continue to see cherry picking of good news in a sea of what could be bad news. So look, if you were counting on this being a deep recession at this point, then clearly you're wrong. I don't know that anybody was, but that was a headline dialogue because it was sensational. Similarly, I think it's completely asinine to think the Fed's going to pivot and all of a sudden start cutting rates at any point this year. They're not going to make that mistake. So where are we? We're still in the case, as Joe alluded to the lag effect of monetary policy, which I believe will hit mostly at the end of this year. Mm-hmm. And we're still in a multiple expansion phase of the market, which defines momentum. So there's no basis. Now,
you think we're still in a bear market?
I think we're basically in a very narrow trading range. I wouldn't call it a bear market.
So you don't think we're in a bear market anymore?
No, I think we're in a very narrow trading range in the market. We're going to go up, we're going to go down. Is the risk more to the downside than the upside? Yes, because how long can multiple expansion go up? But to me, I define bear markets as going down 20%. We're not going to go down 20% from here necessarily because there's too much money that wants to come in.
So even you, who is more negative than most, don't think we're going back to put new lows in?
I don't think we'll put new lows in, but I still think that towards the second half of this year is going to be extremely challenging. And all the people that have been walking around the streets or riding their tractors saying, I'm right, despite the market still being crushed, are going to be disappointed. So I look for idiosyncratic stories where I believe that the valuation is reasonable. I expect that the earnings nose, like a deer, can still go lower, but I'm comfortable that they'll recover. And I think we've seen that. So it's all about positioning in idiosyncratic risk. I'm not playing the market.
Okay.
I'm playing specific stocks.
All right, so let's talk about positioning a little bit. Jenny, so Wells Fargo says the bear market is over. Mike Wilson today says not only is it not over, but the bear market rally soon will be. Okay, here's what Mike Wilson says. Price action is not reflective of the deteriorating fundamentals or the fact that the Fed is hiking during an earnings season. Drivers that should ultimately determine the lows for this bear market later this spring. Bottom line, we don't advise waiting for the obvious signal the bear market rally is over. We recommend positioning now for the end of the bear market rally, is basically what he's saying, in anticipation of the moment of truth before it's obvious and too late. What do you think?
Well, I think they're both right. And I know that's a pretty lame answer, but it's interesting listening to both.
It's a very Weissian answer.
I'd say it's between all of us. But it's interesting because you listen to Joe, and Joe says the road for inflation's bumpy. Of course it is. The road for the market's bumpy. Everything's bumpy. Weiss says that you need to people are cherry picking.
From what I said?
Yeah,
she's writing.
I always do.
Wow.
So you need to be careful because when you take pot shots, no, I'm not giving you that fist bump. You took pot shots, and that was a mean one. I wrote that one down too. But I think, what Weiss said is people are cherry picking good news. And that's true too. So you take Mike Wilson and he says, we're going back to this bear market. But I agree with you. What does that mean?
Well, he says we're never out of it. I mean,
do
you think we're out of it?
I don't know. I think we're range bound. And I think if you look at the market between now and the middle of June, it's in a pretty tight range, kind of like 3,600-ish to 4,200-ish. And I think we're stuck there.
Well, let me ask you, is now the time then, based on what he's saying about positioning, is now the time to fade what's been leading this year because it's
that's
not
fair
legit?
enough. I think that's fair enough. And when we get to our trades and what we've done in the last week, you'll hear that we've done exactly that. So I think what you do with this is you say, well, you're in a pretty good position. I'm going to tell you what I've been working on for research. I've been researching Stanley Works. And for me, this is Black & Decker and DeWalt. We haven't bought it yet. And why haven't we bought it yet? Because I've said to myself, well, we'll probably get some pullback. I want to buy it under 80. Under 80, it's got a 4% yield. I can probably buy it there. And so that's why I'm like, I don't know if I'm in Wilson's camp, Joe's camp, Weiss's camp, Jim's camp.
I'm in Wilson's camp.
I think we're just range bound.
Yeah, Weiss is definitely in Wilson's
without
camp.
the labeling, I'm in Wilson's camp.
Well, not really, because you said, do I think I'm going down 20%, and that would be a bear market? And you said, no, I don't think we're going down there.
I don't think we're going
so what
down
is Mike Wilson really? Then is it a bear market? Or do we need to redefine bull market? And that might be really what we need to do, which is if we're not visiting the October was at 12th lows, then we've ultimately been crawling out of that hole. But if we keep defining bull market as what we experienced for the past 10 years, which is rah, rah, rah party, then no, we don't have a bull market. But maybe
that was raging bull market.
Okay, fair enough. But maybe the new bull market is just not down that much, or just not down, or slowly creeping up with pullbacks in the middle. I don't know. All I know is that you're exactly right. You need to look for idiosyncratic risk, find idiosyncratic positions. There's plenty out there to buy. You can be patient and wait.
Yeah, so you answered my question that gets more to the heart of what we're talking about, whether it's time to start fading what's led you here, right? It's Wilson goes there too, okay? Tech, right? That's really what I'm alluding to. Where he says it hasn't been driven at all by fundamentals. He says that it's been broadly disappointing because of earnings, right? It's been driven by the hope for a Fed pivot, the thing we started talking about at the beginning of the show. And he says, quote, price is about as disconnected from reality as it's been during this bear market. Is that true?
I think Mike's right there.
Price is disconnected from reality as it relates to tech.
1,000%.
I think Mike is correct. I don't know that there's been any fundamental improvement for technology relative to where we were in 2022. I don't see that. I think you could have confidence that the most significant underperformers in 2022 are leading the market higher. What does that usually mean? That usually means that the lows from October, they're safe. But does that mean that I want to concentrate in that direction? Do I want to invest in those businesses? I don't think that I want to go there.
Do you not believe it, or you don't want to believe it because you're not positioned for it, right? I think it's a fair question among a lot of investors.
I'm not positioned for it. I'm not positioned for it. I'm ready to underperform if we continue to see last year's laggards lead the market higher. But I don't see the fundamental evidence in front of me that says these businesses are about to see a growth acceleration once again, that they have the all clear.
He said there's no way to say, Weiss, it's fundamentally driven because earnings in that space have been disappointing.
Yeah, and I think there's a nuance to that. And I'd say the nuance is take a look at Meta today. Meta's up against A because they're cutting more heads. So it goes back to my narrative, which is they're finding something that the bulls are finding something they could hang their hat on. And what they're saying is that this is a much more efficient company at this point, and so I'm going to buy it. And I disagree with that. I think Meta is overvalued.
You know what B of A says today on Meta, which is the first time that I can think about this sort of commentary around that particular name, maybe ever, if not in a very long time. Quote, we see Meta as a more defensive stock in the sector, with the potential for cost rationalization to provide more downside support to EPS in a recession scenario than industry peers.
Except for the fact.
Is this the defensive name in big tech now?
No, it's less ludicrous. It's defensive against Google. Is it defensive against Apple? Is it defensive? Maybe. But the analyst comes out and says it is looking at just that space. So too often we say, B of A comes out and says this is their top pick. No, that's a top pick in the space by an analyst who's got tunnel vision.
$220 is the price target.
Right, and I'd say that why should it be there? They're still betting the farm on metaverse, which we don't know will yield benefits. We don't know if they're monsters CapEx.
In fairness, they have told you, okay, maybe we got off track a little bit. We're going to go back and focus more on the core. We seem to be more focused than we have been in 18 to 24 months.
Right.
Little pushes from some investors like Gerstner. But we've also, tried to right-size ourselves and focus more on what got us here in the first place while still keeping an eye on the future where we're investing.
Yeah, but the issue is that what got them there in the first place is now a more competitive spot.
Yeah, but they still have 2 billion daily active users.
Sure they do, but they've got to monetize it, right? And you've got plenty of ways to monetize it away from Facebook. Look, Facebook it's not a company that's going bankrupt. Was 130 or 118 the right price for it? Probably not. Is
180? Is 180 the right price?
No, I don't believe so. I don't believe so. I don't believe for Microsoft, even though I own a little, I sold some of my trading position. Right now, where it is, 10% off its highs, despite a real slowdown in cloud. Do I think that's the right price for it? No. So I do believe those stocks are overbought, and I agree with Mike on it, except I think that people have bought it for fundamental reasons, not because they're looking at a Fed pivot.
I'll tell you what. Can I tell you what I think is going on here? Thank you. So what I think is it goes back to your people are cherry picking good news. And so when we look at the big tech, the FANG complex, a lot of people are saying, oh, if the Fed pivots, blah, blah, blah. But you know what? None of these stocks were actually propped up on super low interest rates. And they don't borrow. So they're not the ones that benefited directly from super low interest rates. They weren't the zombie businesses that needed them. So why then have they had this big run?
Wait. These companies didn't benefit from zero interest rates?
Not in
Why
the
did their multiples go to the level that they did?
Okay, but not
they wouldn't have gone there without zero interest rates.
They weren't the ones borrowing on 0% just to grow their businesses, right? That's the smaller ones, the Pelotons, the DocuSigns, the Zooms, the ones that came out of private equity.
Yes, but they all benefited.
They all benefited, but I'm saying they didn't benefit directly. So now, if interest rates go up and then come back down, it's not like they suddenly have a huge difference in their earnings because of interest rates going up and hopefully coming back down. So what I think happened here is actually people cherry-picked good news and applied it to this, and I think a lot of people want to relive the party that they've had over the past 10 years and are afraid to try something new, got back into the stocks, hand over fist, cherry-picking, oh, Fed's going to pivot. Fed drove all tech up before. Guess what? It did. It was along for the ride, but low interest rates did not directly, right? It did not directly, by allowing them to borrow at zero, drive those companies to the stratospheric heights. So if that's the case, and I'm right on this, those valuations shouldn't really come down if the Fed slows down. Sorry, they should not be sustained if the Fed lowers rates. This is, little chaotic.
There was a lot of debt offerings and mega cap companies over the last 10 years.
But they didn't need zero.
Apple raised at 25 bips.
But they didn't need it, right? They didn't need it, and they have long-term debt. So if the 10-year goes from, what's it at right now, 3.5, if it goes to 4.5, their borrowing costs are not going to impact their businesses.
There's cross currents to what you're saying. On one hand, you're talking about the fundamentals on the company, but to Scott's point, you had a valuation umbrella from a free money policy over the last 10 years. So I would say that the prices that Facebook reached, or Meta and Microsoft, were never real.
So I go back to the question I asked you, though, about fading this stuff. Like Joe, Joe has gotten out of the Apple recently. He got out of Microsoft recently. Microsoft.